Hi, welcome to Financial Education for the Nation. My name's Warren Shute, and I'm bringing you a update this week on interest-only mortgages. So it came about, ironically actually, by a number of inquiries this week. I've had 3 inquiries this week already from people, different people, from the members of the public saying, hey look, I've got an interest-only mortgage, what should I do? And when I delved a bit deeper, it was, I've got an interest-only mortgage and it's due up now. As in, I've got to pay the mortgage back and I still owe in excess of £100,000. Help. So when I did a little bit digging a bit deeper, the FCA released a notice about their concerns regarding this at the beginning of the year. And actually this year, 2018, shows a peak in the number of mortgages coming due, and particularly interest-only mortgages. And there are another 2 peaks. Let me just grab my dates in 2027 and 2032. So basically what this all stems from is back pre-2007, so pre-financial crisis, a lot of people took out a mortgage and rather than paying back the capital and the interest, all they did was pay back the interest. Now, most of those people should have had an investment or repayment vehicle running alongside, and that would have been the old style PEPs or possibly an ISA that we've got today, or it could even been an endowment policy or a personal pension plan. Personal pension plans were sometimes running parallel to interest-only mortgages, and then the lump sum would pay off the borrowing at the end. So basically with an interest-only mortgage, what you have is, let's say for example you borrowed £100,000 to buy your first home, and then every month, rather than paying anything else back, all you do is pay the interest portion of that. So let's say you're being charged 5% interest, you would just pay the £5,000 a year, 400 and so pounds a month interest, and at the end of the year you still owe £100,000. Fast forward 25 years, you still owe £100,000, but you've paid all those £5,000 of interest during the time. So the biggest concern here is when you get to the end of the 25-year typical term, like these individuals who contacted me were, how are you going to pay it back? How's that money going to get paid back? We've only got a couple of choices. We either sell our children or our savings, or we have to make sure that we've got enough money elsewhere, maybe downsize the house so we can sell the house and downsize that way. So you've got to have some kind of strategy in place. So I just want to cover what your options are in today's update. Okay, so we're talking big figures here, 1.67 million interest only or part interest and capital repayment mortgages out on the marketplace at the moment. And that represents over 17%, almost 20% of the outstanding mortgages are on interest only. So this could affect you. If it doesn't affect you, it might affect some of your friends. So why don't you repost it for me and see if any of those are affected. They might be able to get some help from this broadcast. So step 2 of the money plan is get financially well organised. So financially well organised means know what you've got. Remember, assets, liabilities, income and expenditure. So we need to know what our liability is. So how much money do we owe? Is it on repayment? But then next to that is what assets have we got that we can offset this? So have we taken out an endowment policy? Have we taken out an ISA or a previous PEP? Or did we take this interest-only mortgage out with the intention of using the pension to repay the mortgage borrowing back? Whatever your strategy was at the beginning, let's reevaluate it. Sorry, I got these images come up. Let's reevaluate it. Let's go back and let's ask people, maybe the people who gave us the advice originally, or what we did, what was our strategy? What were we originally doing? Let's recap what was going on. Now, typically, now this is a generalization, it's not specific advice for you, but typically speaking, if you have an endowment policy or if you have an ISA that is put in place to repay the mortgage, for most of you, it will be a best idea to use that money now to repay that borrowing. So in other words, taking the value of the ISA or the endowment and then cashing it in and using that money to repay the mortgage borrowing. Now, little caveat there, if you've got an endowment policy be running less than 10 years, just watch there's no tax liability on that, because there could be. Okay, so taking that money, paying the mortgage down, and then what you've got is a smaller mortgage. But if you still just carry on paying the interest only element on this mortgage, you're going to still owe that mortgage at the end of it and it's still going to be outstanding. So we need to now switch it to repayment. So switching the balance of that mortgage to repayment so it's paid off at the end of the day. Now, that's probably going to be one of your cheapest options. If you find those premiums, in other words, the repayment figure to the mortgage owner on repayment too high, ask if you can extend the term. So rather than being repaid when you thought it was going to be repaid, just push the term out a little bit longer so it extends the term so it's being repaid but over a longer period. So that's going to bring your monthly payments down. But just bear in mind, we don't extend it too far into the future to make the payments too less, because we're going to want to retire at some point. So we kind of want to coincide the absolute repayment of the mortgage at a time when you're going to retire. Now, if you're finding that, okay, that extending it, I need to go past my retirement date, well, I don't want you to do that. I don't want you extending debt past retirement date, because when we arrive at retirement, we want to make sure all our debts are paid and we've got a nice pension to live off of. So only go to your expected retirement date. Now, you can check the state retirement date. I'll put a link on the show notes so you can check what that is, but only go to your state retirement date. Don't go past that. And that will be your retirement vision. That's where you're looking to retire from. And if it's still too expensive, it may be necessary to leave some of the mortgage on interest only. Okay, just some of the mortgage on interest only. But remember, that's going to be owed. So don't put your head in the sand and forget about it. You're always going to owe that money. So try and chip at it maybe along the way. If you get bonus payments, if you get commissions, if you sell an item, do that. And what you might have to do is at the end of the term or before the end of the term, because you don't want to be put under pressure, is you might have to sell your property and downsize. Now that might be part of your strategy anyway. One of your strategies might be to sell the property and downsize, so that's part of it. But at least when you do it this way, the bulk of your mortgage is going to be repaid. So you can have lots of equity there, and then that will allow you to buy a smaller place, which you're most comfortable in, and maybe even release some equity so you can live off that money as well. So let me sort of go back to the beginning and just sort of recap this for you so you're aware of what's going on. Interest-only mortgages taken out typically pre-2007. People took them out because they wanted to make sure that they were affordable every month, and they thought that house price was always going to go up. Some of you would took a repayment vehicle out alongside that to try and repay that figure at the end of the day. Now, if that repayment figure is on track and you're happy with it, then no worries, that's fine. Keep an eye on it, keep it under review, because it is a higher risk approach. If it suits your risk profile and you're comfortable with it, that's fine, but keep it under review. If you can afford just to switch the interest-only mortgage to repayment over the remaining term, brilliant. Keep your savings vehicle going, because that'd be a nice addition to any retirement funding you've got, and you can have that on top. But for a lot of you, the switching your interest only to repayment over the remaining term and continuing the investment vehicle is going to be very expensive, and you may not be able to afford it. If your income's changed over the years, that's great. But if you can't afford it, the second best option is to take what you've saved up, pay it down on the mortgage, watch if there's a tax liability on any endowment policies, reduce your mortgage borrowing, then you've got a smaller amount of borrowing. Switch that borrowing over repayment over the remaining term. If that's not affordable, push the term out a little bit, okay? But don't go past your state retirement age. That's your absolute barrier. Don't go past your state retirement age. We want to get this mortgage paid off as quick as we can. If that's not affordable, it's your state retirement age, you then switch as much of it as you can afford onto repayment, leaving an element on interest only, with the proviso that you will have to sell your home before you get to that end date. Therefore, downsizing, repaying the balance of the mortgage, and what's left over you can keep. Okay, this is affecting a lot of people, so even if it just doesn't affect you, it might affect some of your friends and family that way. So please retweet it or repost it on Facebook. It will be valuable information for them. I am going to include in the show notes a guide from the FCA about what to do. You know, basically, don't bury your head, look up, get financial aid organised, contact your lender, contact your investment savings provider if you've got something. There is always a way. There is always an option for everyone. So please take heart that you can sort this out. You're not on your own. There's 1.67 million people out there doing this, and some of them are falling due this week. I've had 3 inquiries this week on this matter when their mortgages are actually due. And then there's some dates in the future where the big peaks are falling due. Obviously not just falling those dates, it's falling in between times. But this is important stuff. Please take heed. If I can help you with any other questions, please let me know. It's been great listening and hearing your feedback. I do appreciate it. Any other questions you've got, please let me know. My name's been Warren Shute, and this is Financial Education for the Nation. And thank you for watching.